Stock markets, for all their complexities, are ultimately driven by the forces of supply and demand, a fundamental principle that underpins the entire financial ecosystem. When the demand for stocks outweighs the supply, prices climb, painting a picture of a bull market brimming with optimism and confidence. Conversely, when supply trumps demand, prices plummet, heralding the arrival of a bear market, shrouded in pessimism and uncertainty. But what happens when this delicate equilibrium is shattered, sending shockwaves through the global financial system, causing widespread panic and confusion? That's when we find ourselves in the throes of a stock market crisis, a situation that can escalate rapidly and unpredictably. A stock market crisis is not merely a period of declining prices, it's a full-blown economic earthquake that shakes the very foundations of the financial world. It's a time of extreme market volatility where fear and uncertainty reign supreme, leading to a dramatic loss of investor confidence and stability. This fear becomes a self-fulfilling prophecy, driving investors to dump their stocks en masse, further depressing prices and exacerbating the crisis. The consequences are far-reaching, impacting not just Wall Street but Main Street as well, affecting everyday lives and businesses. These crises often expose underlying weaknesses in the financial system that had been masked during periods of prosperity, revealing vulnerabilities that need addressing. Like a crack in a dam, what starts as a small fissure can quickly escalate into a full-blown breach, unleashing a torrent of economic turmoil and chaos. These events serve as stark reminders of the interconnectedness of our globalized world, where a crisis in one corner of the market can quickly spread like wildfire, leaving a trail of financial devastation in its wake, affecting economies worldwide. Understanding stock market crises, their causes, and their profound impact on the global economy is essential for investors and policymakers alike, as it helps in crafting better strategies. By studying these events, we can learn from past mistakes and hopefully mitigate the severity of future crises, ensuring a more resilient financial system. After all, those who fail to learn from history are doomed to repeat it, making the study of past crises not just important, but imperative. The 1920s in America roared with prosperity and boundless optimism. The stock market soared to unprecedented heights, fueled by speculation and a seemingly insatiable appetite for risk-taking. However, this economic euphoria masked a brewing storm on the horizon. Overvalued stocks, excessive borrowing on margin, and rampant speculation created an unsustainable financial bubble. The bubble finally burst on October 24th, 1929, a day that would forever be etched in history as Black Thursday. The stock market crashed, triggering a chain reaction that plunged the entire world into the Great Depression. Banks failed, businesses shuttered, and millions found themselves suddenly unemployed. The very fabric of American society was torn asunder. The impact of the Great Depression was profound and far-reaching. It wasn't just an economic crisis, it was a deeply human crisis. Families were torn apart, dreams were shattered, and a generation was scarred by the experience. The crisis exposed the fragility of the global financial system and highlighted the devastating consequences of unfettered speculation and a lack of regulatory oversight. The Great Depression serves as a stark reminder of the importance of sound economic policies, responsible lending practices, and a well-regulated financial system. It also underscores the critical role that government intervention can play in mitigating the effects of such crises and providing a safety net for those most affected. The year 1987 began with a sense of optimism and high expectations. The global economy was on an upswing, and stock markets around the world were enjoying a robust bull run, with investors feeling confident. This period of prosperity, however, masked underlying weaknesses in the financial system, particularly in the nascent world of computerized trading, which was still in its infancy. On October 19, 1987, these weaknesses were brutally exposed in a dramatic fashion. Black Monday, as it came to be known, saw the Dow Jones Industrial Average plummet by a staggering 22.6%, the largest single-day percentage drop in history, leaving traders in shock. This dramatic decline sent shockwaves through global markets, triggering a wave of panic selling that spread like wildfire across continents, affecting economies worldwide. The speed and ferocity of the crash were unprecedented, fueled in part by the nascent use of program trading, where computers automatically executed sell orders based on preset parameters, amplifying the chaos. These programs, designed to mitigate risk, ironically exacerbated the crisis by flooding the market with sell orders, creating a downward spiral that seemed unstoppable and relentless. While Black Monday was a day of profound fear and uncertainty, it ultimately proved to be a relatively short-lived crisis, with markets beginning to stabilize soon after. Unlike the Great Depression, which lingered for years, the 1987 crash was followed by a swift recovery, with markets rebounding faster than many had anticipated. This resilience was partly due to prompt intervention by central banks, which injected liquidity into the financial system and restored confidence in the markets, preventing a prolonged downturn. The 2008 financial crisis was a stark reminder that even in the 21st century, with all its technological advancements and supposed financial sophistication, the global economy remains vulnerable to the same old pitfalls: excessive risk-taking, lack of transparency, and regulatory failures. Despite the lessons of the past, the same mistakes were repeated, leading to devastating consequences. This crisis, rooted in the US housing market, quickly morphed into a global financial meltdown, exposing the interconnectedness of the world's economies and the dangers of unchecked greed. The ripple effects were felt far and wide, affecting millions of lives and livelihoods. At the heart of the crisis lay the subprime mortgage market, a ticking time bomb waiting to explode. Lured by the prospect of easy profits, lenders had extended mortgages to borrowers with poor credit histories and low credit scores, the so-called subprime borrowers. These risky loans were a gamble that seemed to pay off, at least initially. These risky mortgages were then bundled together and sold off as complex financial instruments known as mortgage-backed securities. Investors, hungry for high returns, snapped them up without fully understanding the risks involved. As long as housing prices continued to rise, everyone in the chain profited handsomely. It seemed like a win-win situation for all parties involved. However, this house of cards was built on a foundation of shaky assumptions and unsustainable practices. When housing prices began to falter in 2006, the dominoes started to fall. The illusion of endless growth was shattered. Defaults on subprime mortgages surged, sending shockwaves through the financial system. The repercussions were immediate and severe. The value of mortgage-backed securities plummeted, leaving banks and financial institutions holding billions of dollars in toxic assets. The financial stability of these institutions was now in jeopardy. The collapse of Lehman Brothers, a venerable investment bank, in September 2008 marked a turning point in the crisis. It was a wake-up call for the entire financial world. It sent a chilling message that no financial institution was too big to fail. The myth of invincibility was debunked. Credit markets froze and panic gripped the global financial system. The fear and uncertainty were palpable. Governments around the world were forced to intervene, injecting trillions of dollars into the banking system to prevent a complete meltdown. The coordinated efforts were unprecedented, aiming to restore confidence and stability.